Is the risk-off trade nearing an end? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Steve Miley, Chief Analyst, COO, and co-founder of TradeDay. Hi, Steve. Welcome to Real Vision.
Hey, thank you very much, Maggie. Pleased to be here.
So this is your first time with us. So before we jump in and talk markets, why don't you tell us a little bit about yourself and TradeDay?
Yeah, sure. Well, I've been in the industry for a very long time. Became interested in financial markets as a teenager, through university. Then went straight into financial markets. I actually started on the life floor, which was the equivalent of the Board of Trade or the Merc here in Europe. That's where I started my. So with the bright jackets and all the hand signals. So I started there. Very exciting times. But then segued into research. I was at Merrill Lynch, Bank of America, 15 years, and then I actually headed up the FX technical analysis department at Credit Suisse for 3 years. And then after that, I moved into set up my own business where I'm selling technical analysis research reports back to the industry. So back to hedge funds, institutional client bases, whether it's brokers or banks, and then also to high net worth individuals. So that's been my journey pretty much up until more recently. And in the last couple of years, we've kind of moved into the space of the retail space of funded challenges. So that's what TradeDay is all about. We're a funded challenge program where you come in and you can purchase a challenge, try to hit the profit target before you hit the loss levels, and as long as you stick to the rules, then we fund you into the real live market. So that's
interesting. Kind of a gamification. It's not like sports betting, but there's a sort of a gamification aspect to it.
There is a slight gamification aspect to it, yeah. So the industry's been around for like 10, 11, 12 years, really. But we've come into the industry the last couple of years, trying to do it from a different aspect. What we're trying to bring in is that, say, myself and my co-founder James, he has a long institutional background as well, but more on the actual professional trading side, the prop firm side, right. Setting up big prop firms, prop trading floors in China. And so, yeah, we've tried to bring that kind of professional, institutional kind of aspect to the retail space. So giving these guys, institutional grade research, technical analysis, macro fundamental, also offering news squawk services. And then on top of that, some mentoring and psychological and risk management tools that we bring to the table that, others in the space are not so much bringing. So we're trying to bring all of that to kind of level up as much as we can the retail guy. And we think that's really important, that's been a big growth for the since, well, really the last 10, 15 years anyhow. But I mean, I think a big push post-COVID, the whole, Reddit kind of explosion that we saw. Yeah. There has been a bit of a leveling up, and we're going to see hopefully more of that. And that
we need to, right? We all need to be taken care of, and we're that's certainly our mission as well, is to try to inform and arm people with the information they need so they can make smart decisions. So happy to hear it. So all right, so let's dive in then, and let's start with stocks. As we kind of look, because you look across all assets, which is great, because so do our community and listeners. So let's start with stocks. Mixed action today. It was kind of it felt a bit like a Monday. Everyone recovering from last week, trying to figure out what's going on. It seemed like for most of the day it was a little bit of tough sledding, a little bit mixed, right? We had the NASDAQ out ahead, and then it was the Russell and the Dow lagging. Looking across, we've just closed here, and the NASDAQ actually up 1%. So it kind of gained as the day went on, and Dow managed to drag into positive territory, but Russell still down a 0.25%. So we posed the question about the risk trade because you were talking about that in your research. So how are you feeling? You feel like an appetite for risk is returning, or is there more danger out there as we look at equities?
Yeah, I mean, so I've got a couple of charts I think we can share. But I think starting off with the S&P is probably, the main place to start. The broader index, the kind of the benchmark really. And from my perspective, this has probably got a little way to run. If I look at it just purely on the technicals, you've got a small topping pattern that's built up in here throughout July. We've reversed down through the trend lines that you see coming up in here from March, and the trend lines up from May. We're down through both those trend lines now, and that's kind of topping pattern alongside the reversal of the trend lines. You've now got a series of lower lows and lower highs. So there's still some negative pressure, despite the little pop you've seen today. It's probably not enough yet. And my kind of concerns, I mean, I'm kind of a bit of a natural bull. I've got that in me. I try to, obviously as an analyst, you try to be as neutral as possible, but I do have a little bit of a natural bull in me. And we're in a big bull run that we've been in right the way from October. But I think there is some downside pressure that's still probably due to come through. But I think we're nearing the end. And I think that's the case in a lot of these markets we're going to visit now. We're probably these correction phases we're in. We've been in them now for like 3-4 weeks. We were in some cases fairly overextended, overbought, particularly in the tech area, on individual stocks and in the NASDAQ, which we'll look at shortly. But I think there's still some more to come to the downside. I don't think today's anywhere near enough to say that we're over yet, but I think there is still some risk. So for me, down to like those swing lows that we had in June and July, 44.11, 43.70 maybe on the S&P. That's the risk on the downside for the broader index at the moment.
So we're going to get some insight into the consumer this week. We have earnings from major retailers, always sort of the last usually wave to come out. They're on deck. We get a monthly retail sales report.
Yeah.
The following week, we also get NVIDIA. That's going to be a monster report.
Sure.
That was like the linchpin of that tech movement. You see a catalyst in any of this? How important? How are you kind of positioning ahead of that?
Yeah, well, I think there is some risk, as I say. I mean, it will be interesting to see those. So we've got like Walmart, Target, and who's the other? There's another biggie, right? Coming out.
There are quite a few. And Walmart, if I'm not mistaken, hit a new high, or they got an upgrade today. They were on the move today. I think they were one of the movers.
Yeah, so I think they're going to be interesting to see, after particularly you said the inflation numbers, we've got the retail sales numbers, got the Fed minutes as well. Do we get any insight which way the Fed are going to be leaning? But for me, just, on the technicals and the fundamentals, I think the risk still remains slightly to the downside. And, as you say, we're coming towards the end of those earnings. The big tech has all come through. Mostly it was positive, right? Most of that big tech was positive, and it still didn't allow markets to continue. Because I think we've very much been in that kind of buy the rumor, sell the fact, right? So we've had a real strong push higher through mid to early July to those peaks that we put in at the end of last month.
So let's pull the NASDAQ up, because we're kind of talking about tech. Why don't we pull the NASDAQ up and look at that? Because and again, people felt like maybe most vulnerable, maybe the most overbought, and yet you see that kind of leading the way today, which is interesting.
Yeah, so we have had that little bit of a rebound today, but you can see we're still got that kind of in that on the chart here. We're still in that kind of downtrend. I mean, upside for me, if I'm just looking at pure technicals, it needs to clear 15,610. That kind of swing that we had back a week or so ago. Only through there we'll like kind of shift it and see it really shifting more bullish back for me. I still think there is that risk of another small down leg in here. One more phase lower, but then I think there's going to be a real longer term buying opportunity. I think we're going to get one more push lower, and then I think it kind of sits with and maybe we'll come to talk about it shortly, what we've seen in the sound bites regarding this potential for yields to push now have one more spurt to the upside in yields before we kind of get yields turning round again. And I think that's going to be the key driver, and then I think that's going to be potentially pushed by a shift in tone from the Fed, which is a little bit further out, I think, but I think that is coming. That's down the line. That's for me going to be the catalyst going forward. So I think the risk in the short term is maybe another down leg, maybe a bit of disappointment around the consumers, as you said there, with the data we have coming up this week. And you've got to remember, like last week we had that CPI data, which was better than expected. The initial market reaction was very bullish. We had a real positive reaction. And then the actual price action to end that day last Thursday, was fairly negative. And then PPI kind of was a bit disappointing. So for me, when a market can't react to a positive piece of news and it reacts the other way, that the writing's a little bit on the wall that we've got a bit more to come. Equally, kind of just switching focus very slightly and geographical focus, there have been a lot of headwinds out of China, right? And maybe it's a bit soon to go there, but we've had, we've had the property market downturn. We've got deflationary pressures coming out of China. Those numbers continue to come through. We've had a few scares overnight, regarding some non-payment of interest payments and maybe a contagion into the financials from the property world. And the markets have been pretty resilient, given these kind of quite negative headwinds coming out of China, which is effectively the factory of the world. These inflationary pressures. And the markets, I think, have been relatively resilient given that. And I think what we do have potential down the line from China is stimulus that they're talking about. They're kind of leaking very slowly, but we're not really getting that coming through. So I can fully see potential for a shift where we get some positive stimulus coming out of China, and then maybe hand in hand with some hints from Fed speakers that we're going to shift. And I don't expect any kind of shift to dovish. I don't expect any kind of real signals of rate cuts coming, but there might be these little signs, these little signals of a shift to more dovish. And then that could see yields reverse significantly to lower yields, and then allow obviously growth stocks, tech, NASDAQ to push higher, and the broader market to go higher too.
Yeah, so it's a sort of two-phase situation here where you see this very near-term potential for more downside for equities, but then maybe some reasons. And fantastic to bring up the China news. I mean, there was a time when an Evergrande type headline crossed, and it really had ripples through the global markets. Are you thinking that it's markets resilient, or is it just that everybody's on vacation in August? So sort of people are not really focused on this, or a bit of both?
Yeah. Maybe a bit of both, but I don't quite buy into that. Everyone's away in August, lower liquidity. I mean, that's undoubtedly the case. But you know what? The players that are around, we're 24, not quite 24/7 markets, but everyone
who can afford to not pay attention.
Exactly.
Right? So maybe that doesn't exist anymore.
Exactly. So you can't say, okay, I'm going to wait. I'm on hold for 2 weeks. We're on holiday. We're on vacation. So I think, if that news was felt to be that significant, and then I think we would have been, and China was down, stocks in China were down, the Hang Seng was down overnight. When I got up in my morning, I'm in the UK, and European stocks were under pressure from Asian stocks off the bat, and the S&P and the NASDAQ were making lower lows than we posted back on Friday, and then by the time the US opens, it's kind of turned around, and that news has been discounted out. So I think there is an underlying resilience. There wasn't any kind of real contagion outside of Asia. It doesn't mean that couldn't escalate a little bit. But for me, I think we are seeing a lot of headwinds, being kind of ignored, or we're battling against it. I don't think they're being ignored. I think we're battling against those headwinds in out of Asia, out of China, and markets. Even though there is, I think there is a risk lower, and I think that kind of ties into what we'll probably discuss on on the bond markets and yields.
Yeah, I think it's worth getting into that. I just want to share something, and I think Joshua S makes a good point. He's saying more push lower thanks to consumer spending decrease from Walmart earnings call. I'm just highlighting that because I think, and I'd love your thoughts on this, it's not going to be just the headline, and it's kind of been this way with tech too. It's not just going to be the beat on the headline, on the revenue. I think people are really going to start to pay attention, especially for the retailers, really start to pay attention about what they're saying about the consumer and how they're holding up.
Indeed. Yeah, I couldn't agree more. If you look at the actual numbers, the where we were versus consensus on, most of earnings, it was a sea of green, everything, pretty much beat earnings, but a lot of that guidance was a lot more suspect. So, I think, Joshua's nailed it there. It's going to be, where the guidance is read the consumer, and what we're really seeing, and I think, the markets have been, actually, probably for the last 6 to 9 months, really, we've had this kind of almost like counterintuitive, but, once you kind of understand it, these counterintuitive moves, it could just be a little bit of a slowdown, right? A little bit of slowdown from the consumer could be a very slight positive. It doesn't mean we're going to fall off a cliff edge. It doesn't mean we're going into a recession, but, that kind of natural slowdown, a slight rise in unemployment, is probably what the the economy needs in order to assist the slowdown in inflation, and then allow the Fed, if we're, if the employment situation is really strong, if the labor market is tight, it's going to put the Fed off, being more aggressive on any kind of rate cut. So I think you need that kind of Goldilocks, right? Not too hot, not too cold, just about right. And I think, a little bit of negative guidance from the retailers could actually be seen as a positive, almost counterintuitive as a positive, in that it means we're slowing down without, tipping the economy into any kind of recessionary fears.
Great point. I think that's a great point. We often get people say, so is bad news good news? Is good news bad news? Exactly. A little bad news might be good news here. So let's talk about the bond issue. We were talking before the show, sharing thoughts. For those of you who watched all last week and have been watching our other coverage, we've been kind of a lot of concerns creeping up, a lot of great insights coming out last week of people were saying, hang on a second, much like you just said, Steve. There was a reason for the market to do well. The inflation data was pretty well behaved, and it kind of fell apart, especially on treasuries. We saw volatility. We saw yields on U.S. treasuries moving higher, and a growing concern that maybe yields at the long end are vulnerable to a further move higher, at risk for a further move higher. My colleague Ash Bennington was doing an AMA with Raoul, Real Vision co-founder Raoul Powell, and I asked Ash to put it to Raoul, because Raoul's been talking about bonds, get his thoughts on what's going on. This is what he had to say last Friday. Have a listen.
But actually, I spent a long time thinking about this, because all of the business cycle indicators, all of the forward-looking inflation indicators, all of the unemployment indicators are all suggesting the bond yield should come down, and that inflation continues to fall, both at core level and at headline level, and that unemployment continues to slowly grind higher. So why are bonds not suggesting that? While equity markets already started pricing in the fact that there's more liquidity in the system. And I think it's down to supply. I think it's really down to supply, because the Treasury has to issue a lot of bonds to finance both the interest payments from the bonds that are coming from maturity, set at higher rates, and the new borrowings that they have. The bond market is already trying to absorb a bunch of this stuff, and there's just not the ability to absorb it all. So supply is pushing yields higher for the time being as the Treasury rebuilds its coffers. The issue is there's about $6 trillion of debt maturing between now and the end of the year. What the Treasury have been doing is issuing short-dated notes generally to finance it. The reason they're doing that is they don't want to lock in 5% rates, because before you know it, the budget deficit explodes high.
Right.
So there's a game that I think they're playing here, is the Federal Reserve have to, and all the central banks doing the same game, because I think they're all in cohorts, part of this everything code theory. They are going to try and hold this rates up as long as possible to make sure inflation undershoots. Because when it undershoots, they have the cover to cut rates back down to trend rate of GDP growth, which is like 1.75%. So I think the narrative will break by Q4 when we'll start to see the Fed cutting aggressively. In the meantime, do yields go higher? I don't know. I'm watching them closely. There's a risk that they do, and I'm stuck in a bond trade that's losing money. I've had a great year on technology and crypto, and having offset some of that in bonds. So I still think bond yields end lower, but there is a risk that they lose control here because of the supply side, and there's not enough liquidity in the bond market right now. And therefore, I think that increases the chance of some yield curve control, whether it's like an intervention in the bond market. And we've seen that in the past. It's not uncommon for the US to do. Japan obviously does it. The UK did it recently as well. So listen, I think this turns around, but could it squeeze higher first? Yields for sure.
All right, that was a long one, but it was worth it, because a lot of you were asking last week, knowing that Raoul had a position in bonds and had been expecting yields to go lower. So we wanted to make sure that we got his thoughts on that and shared it with you. So that was for all of you who asked. And for those who want to dive deeper into the topic, maybe ask some follow-up questions, Raoul, Julian, Brigden, and Harry Melandri will be doing a Pro Macro Insiders live this Thursday, roll up and ask more about it. I'm sure this topic is going to come up. And Andreas and Ash just wrapped the business cycle AMA, which is available on our platform. So Thursday, it's at 11 a.m. Eastern. Raul, Julian, and Harry, and the AMA already happened, so you can get full access to that on our platform to access both and all of our other conversations about what's going on with this bond volatility. Scan the QR code and come join our community. And it's important because, Steve, right, that what's happening in yields has the potential to impact equities. Like everything will become interconnected, especially if you get sort of an outsized move in treasuries. That volatility is problematic and unnerving to some people. So we've got people asking, what's your view on what's happening with treasuries? What are you looking at?
Yeah, so if we can bring up we've got the US 10-year note future chart, so we can look at that. But I mean, I think I'm going to reference more the yields because I think it's more important. So as you can see here, the 10-year future, we're sitting right down on the recent low at 109.24, having already pushed below the July low at 110.05, having previously pushed them below the March low at 110.27.5. But if we look at it from a yield perspective, starting on the 10 years, we're pretty much sitting right at yield peaks around 422 at the moment, and that's also a yield peak going back to its last year. We're like November last year, and I think there's a real risk. And Raul was really I'm kind of on the side. I don't want to sound like a suck up, but I mean I'm kind of on the sort of same page as Raul. I mean I think there is real risk that we get a spike higher in yields. And if 10-year takes out like 425. The peak from last year or the second half of all of last year, the peak has been like around 433, 34, 35. So we could easily be there in like a heartbeat, and then maybe up towards like 4.5%. And it's kind of similar numbers on the 30-year as well. So like through 435 takes us up to 442, 443, and again maybe 450. So those long ends could easily spike, I think, to higher yields in the short term. However, my underlying view would then be that then the risk is still then back to significantly lower yields after that move. And I think it's interesting, Raul was talking about his positioning. You've had Bill Ackerman at the beginning of August talking about, putting on significant, shorts, and the hedge fund community. If you look at the CFTC data in here, the latest data has put it even at a bigger extreme, particularly on the long end, on the 10s and the 30s. It's becoming a bit of a crowded trade. So it doesn't mean it can't go further. This short positioning by the hedge fund and the fast money community, and I think that is the risk that it does go there. But then inevitably, if it flashes out to those kind of levels, 10s and 30s going out to 4.5%, then it could really, as they all unwind that, it could really then come back just as viciously, and then we see a reversal back down to lower yields.
Okay, that's super important. So because and thank you for sort of giving some color on that, because it's not just about the Fed or the Fed minutes. There is the market positioning matters here. So first of all, it sounds like volatility a real concern. That big up and down.
Yeah.
What happens to risk in that? What are the implications of that? Because Raul said something very important in that statement, and he's obviously watching things and with concern. One thing to just put a pin on that, we have to remember Raul has a long-term perspective. And I know this, we talk about this all the time, Steve, and I'm sure you do as well. Time perspective matters, right? So you're telling us in the short term, I think this, in the medium term, I see this. So Raul's point of view, as he always reminds us, is long. So his bond call is still long. But one thing he said in that's really important, if you have a shorter time perspective, is he's worried about the possibility they lose control. That, and we had Vincent last week warn of like a guilt-like moment where this thing starts to move, and talk to me about the positioning of the market. Can a momentum build on itself? Is that worrisome to you? What are the implications of that?
Yeah, I mean, I think the fact that the market is very crowded and the fast money, again, like we're talking time horizons. I've always said as an analyst, I used to get asked all the time, what's your view? I always answered the question with a question, right? What's your time frame? I can be bullish, bearish, neutral, bullish, bearish on 5 different time frames, right? So it's right to qualify that. For me, all the risk is that we've got a crowded short trade in here at the moment, but that could explode lower. And if we do see that kind of increased volatility, we could see it blow out through down towards 4.5% on 10s and 30s, maybe even beyond that. But then that hedge fund community is likely to then to cover those fairly quickly as well. So I don't see us being there for a long time, as long as it's not too aggressive. If we start spiking towards 5%,
does anything break? That's what happened with gilts, right? And then they had to step in.
Yeah, they did. But then that was, I'm in the UK, right? That was because we had this like a shocking decision, political decision.
Right. There were other things behind
exactly. There was a huge, unbelievably, in hindsight, the most stupid probably political decision anyone's ever made. Excuse me. Which
well, hang on. We have time here to see if we can. let's not throw down that challenge, shall we?
Right.
Heading into an election year in the U.S.
Yeah, quite. But politics aside, I think that. And the other thing is what you could see is like the not only would you have the shorts from the fast money community, the hedge fund community, but you've got, it's not a crowded trade, but the longer term longs are still kind of a heavily, still long, right? So they could get forced out. But I don't see it being, I don't personally see the Fed, I know there's been talk of them maybe coming in, and some kind of yield curve control or, buying bonds or whatever it might be. I don't particularly see that happening personally. I don't think that's going to be, but I think we could see a flush out to lower prices, higher yields, and then a quick return. And I don't think, a move to somewhere between 4.5%, 5%. Now, if it goes beyond there, then there might be some increased political risk, and some increased problems. And you could then see, some kind of intervention, kind of stuff, almost as you're implying there, almost it turning into almost like a geopolitical event, as opposed to, it's a structural event for the market. Personally, I don't see that happening. I think the market can cope with that, as long as we kind of revert back higher. And I think that would be my take on how it would happen. And that really kind of then sits alongside my view on the stock market and the indices, is that they could potentially be lower from here on that kind of flush out to higher yields, and then it's a big buying opportunity for stocks as well at those lower price levels we've just been talking about.
Yeah, let's round it out with the dollar. And if you want, we had dollar, gold, and oil. We're not going to get through them all, but
sure.
What's most important, and are they interconnected? Because everyone was predicting dollar lower, waiting for gold to break out, which just stubbornly hasn't. And then oil's been interesting, and a lot of people maybe thinking the oil rotation trade is back.
Yeah, I mean, I think, just to run through those, the dollar has, I think, caught, many people thinking a more dovish Fed, weaker dollar, and the fact that the dollar's rallied, it's been really super strong the last few weeks on this kind of more of a risk off trade, and obviously the move to higher yields. So probably see again that probably continuing with the risk that yields are going to continue higher. And then on the back of that, gold just doing the inverse. It's not acting like a safe haven. In this case, it's just doing the opposite to the dollar. So there's potential further weakness, I think, to come in gold. Mm-hmm. And I think, you say that oil's been the real outlier. What's really odd, strange about the price action in oil for me has been that the macro events, the increase every time OPEC plus OPEC, really Saudi Arabia has increased and announced further increases in supply or elongated the timelines on supply increases. You've seen an initial push, as you would expect, higher in price for oil, and then a quick reversal back lower by the markets, over the last 2-3 months. However, the last 2-3 weeks, we've had nothing out of OPEC and Saudi, and then all of a sudden oil is just up in the face of a risk-off move elsewhere. So it is a little bit of a conundrum. I've never liked charting oil because, at risk of saying this, the market doesn't act like a fully natural market. I'm just going to put it like that, right? And let you draw conclusions. And so from a technical analyst point of view, it can be warped a little bit. So it doesn't necessarily behave as it should. But nevertheless, I think, oil, I think, is a bit of an outlier. It's not necessarily telling us what we want to know about what's going on in the real global economy, right? Because you'd argue that everything out of China is more negative. It should see oil lower. So I think oil we park to one side, but I think the gold and oil trades are kind of lining up. For me, as much as I, and at TradeDay, our a lot of our focus is on stocks and equity indices because that's what people like to trade. But I mean, I think, you have to right now have an eye on those Treasury markets right across the board. It's not just 10s and 30s, 2s and 5s as well. There's a crowded trade in the 5s as well. So I think, it's keeping an eye on the levels there, watching and waiting for the breaks there. And then you're either going with them again on this timeline, short term, if we're going to break to lower prices, higher yields, then stocks are going to go lower as well. But then I think eventually there's a great, slightly longer term buying opportunity on stocks and on bonds that's going to come our way, probably not in August, but I think going into September.
Fantastic stuff, Steve. Such a pleasure to have you on. Thank you so much. Great conversation.
It's been a pleasure to be on. Really has.
Great stuff. We'll see you again soon. And thanks to all of you for the great questions. Before we go, just a reminder, 2 things. Remember those if you want more on the bond volatility, the programs I mentioned, we're going to be diving in deep on the platform. And also, we've just launched season 2 of the Real Vision Collective. The Real Vision Collective is on a mission to bring you all of your favorite NFT communities together while giving you the knowledge you need to navigate Web3. If you want to help us keep building the super community of NFTs, head over to realvision.com/collective to learn more and mint your own season 2 NFT. And if you haven't joined Elaine's DGen happy hours on Friday, 2 p.m. Eastern, you're missing something. They're great fun. So roll up to that as well. We'll be back tomorrow with Tommy Thornton. In the meantime, hope you join us. In the meantime, take care and good luck out there, everybody.
At Real Vision, we're closing the doors. But not how you might think. You see, this autumn we're launching the new Real Vision, a platform built around the universal truth that knowledge times tools times network equals success, your success. It's the biggest transformation in our history and brings together everything you need in your journey, from information to knowledge to wisdom, all in one place. That's incredible AI, charting tools, networking, economic data, watch lists, notes, and a whole ton more. We start rolling out to our current members at the end of August, and from August the 15th, we're closing the doors to any new members while we focus on that. But you do have one final chance to get in that door. Until August the 15th, you can level up for a whole quarter of Real Vision just for the price of $20.14. When you go to realvision.com/last chance, you'll see why we chose that price in particular. It's something about Real Vision of old. You'll get to experience the new platform before the general public with no obligation to stay after that 3 months and a price that works out for like $6 a month. It's what you call a no-brainer. Anyway, I hope to see you on Real Vision. It's an incredible community, and my God, this new platform is going to be extraordinary and will change as many lives as possible.